Market structure is among the most powerful concepts in trading, yet many explanations make it seem far too complicated. The reality is, it's actually simple if you concentrate on what truly matters. But first, don't forget to like this video and subscribe to the channel if you'd like to watch more high-quality videos like this for free. See you right after the intro and disclaimer. Three types of market structure you truly need to understand: uptrend, downtrend, and range. Let's keep it simple and break each one down. First, the uptrend. This occurs when price continues moving higher. You'll notice higher highs and higher lows, which simply means buyers are in control. In this type of market, the smart approach is to seek buying opportunities when price pulls back. Second, the downtrend, same concept but in the opposite direction. Price forms lower highs and lower lows, indicating sellers are in control. So, instead of buying, you look for selling opportunities to follow the trend. Third, the range. Price isn't moving significantly up or down, but instead drifts sideways between support and resistance. Here, buyers and sellers are essentially balanced. This is where many traders get stuck or take losses. There's no clear direction to follow. Now, here's the key point. Market structure is simply the pattern of how price moves, whether it's forming higher highs or lower lows. These movements reflect trader sentiment, fear, greed, and hesitation. When you understand these patterns, you gain a clearer sense of what the market is doing, which helps you trade with the trend rather than against it. Now, let's move to another important concept. Look at this strong move right here. Price is climbing rapidly with large green candles, almost no wicks, and each candle closes higher than the previous one. This type of move is called an impulse. It shows that buyers are fully in control, and most importantly, price breaks above the previous high. That break signals that the trend is now heading upward. Here's what typically follows a strong move like this. After that big push, price starts to slow down. You'll notice smaller candles, some red ones, and possibly some sideways movement. The candles lose their clean look, wicks appear, and price doesn't travel as far with each candle. This is the pullback, the market taking a brief pause before the next move. Here's the critical part. Price does not drop below the last low, meaning the demand zone is still intact, and the market is preserving its structure. Then, suddenly, price finds support and rises again, making a new high. That's a strong signal the uptrend remains intact. Smart traders wait for this pullback to enter a buy position, not after the big move has already taken place. Here's a common problem traders encounter. They look at a chart and can't tell if price is trending upward, dropping, or simply moving sideways. They try marking zones or drawing trend lines, yet it still feels unclear. So, how do you solve this? It begins with understanding swing highs and swing lows, the key points where price changes direction. A swing high forms when price moves upward, then reverses and begins falling. A swing low forms when price moves downward, then reverses and starts rising. For example, if price pushes upward and then pulls back, that high point becomes a swing high. If price drops and then bounces back upward, that low point becomes a swing low. Why does this matter? Because if price breaks above a swing high, it often signals that buyers are in control and the market could move higher. If it breaks below a swing low, it usually indicates that sellers are taking over and the market may move lower. Swing highs and swing lows act like signposts on the chart. They highlight where price is turning and provide a clearer picture of the trend. Spotting a swing high or swing low is easy, but the real question is whether the trend will continue or reverse. That's where two simple tools come in: break of structure and change of character. Let's begin with break of structure. Imagine the market is in an uptrend. Price is forming higher highs and higher lows. Then, price pulls back slightly and pushes higher again, breaking the previous high. That's a break of structure. It signals that the uptrend remains strong. You can draw a line across the last high to mark it. Once price breaks and closes above that line, that's your confirmation, the market is still bullish. Now, let's move on to change of character. This one tells a different story. Suppose the market was in an uptrend, but this time price fails to break the last high. Instead, it forms a lower high and then breaks below the last low. That's your change of character, the first sign the trend may be shifting. The uptrend could be ending, and the market might be turning bearish. So, When you spot a change of character, it's time to pay attention. You may stop looking for buys and start watching for potential sell setups. Here's the simple way to remember it. Learning to identify these on the chart keeps you one step ahead. You'll know when to stay with the trend and when it might be time to adjust your strategy. Strong lows, weak highs. Let's identify them on the chart. First, notice how the market is in a clear uptrend. Price is forming higher highs and higher lows. Each time price pushes upward, it pulls back slightly, then moves even higher. That's a strong bullish structure. Now, focus on these pullback points here. These are what we call strong lows. See how price dips into these areas, but buyers step in and push it right back up. These strong lows act as support. The market respects them, and they help maintain the uptrend. On the other hand, take a look at these highs. These are what we call weak highs. Price hesitates around them for a short time, but notice how they don't hold for long. The trend eventually breaks through them. In a strong uptrend, weak highs are usually taken out as price drives to new higher highs. Now, let's cover something very important: how to spot a confirmed swing low, a valid strong, and why it matters. Let's walk through this together. Imagine we're looking at a real chart and price is trending upward. You see how it moves higher, then pulls back slightly. That's normal. Price doesn't travel in a straight line, it moves in waves. Now, focus on the pullback. The lowest point of that downward move is called a swing low, but it's not confirmed yet. It only becomes a confirmed swing low once price pushes higher and breaks the previous high, what we call a break of structure. You might notice small dips during the pullback, little lows here and there. Ignore them, they're just noise. The true swing low is the lowest point price rebounds from before forming the new high. So, how do you mark it? Start by locating the last swing high, or a weak high, just before the break of structure. Draw a horizontal zone from that area. Then, within that zone, find the lowest point where price stopped falling and reversed upward. That's your strong low and your confirmed swing low. Why is this level so important? Because it marks where buyers stepped in with strength. If price pulls back and reacts at that level again, it's a strong sign the uptrend is still intact. But if price drops below it, the trend may be shifting. After a break of structure, watch for a pullback. That pullback often retests the strong low. If buyers defend it, that's a high probability area to consider a buy, as you're trading with the trend from a strong level. And in a downtrend, it's the same concept, just reversed. Price trends downward, makes a low, pulls back, then breaks a previous low. Mark that broken low. When price pulls back to it and sellers step in, you have a clear opportunity to sell with the trend. What's our goal here? In a bullish market, buy at strong lows where buyers push the price higher. These are the best entry points for long trades because the uptrend is likely to continue. In a bearish market, sell at strong highs where sellers drive the price lower. These are the best entry points for short trades because the downtrend is expected to persist. By following this strategy, you stay aligned with the market, increasing your profit potential while reducing the risk of trend reversals. The key to success is remembering that the trend is your friend. Whether the market is trending up or down, sticking with the trend helps you avoid fighting against it and boosts your chances of being on the right side of the move. Now, let's move on to another powerful concept: how to identify a valid pullback. To do this, we use the Fibonacci tool. Alright, let's jump onto the chart and identify a valid pullback together. As you can see here, price has been moving upward. If the market were about to turn bullish, we'd expect to see price forming higher highs and higher lows. But let's take a closer look at what actually happens next. After some time, we notice price begins to pull back slightly. It's just taking a pause in the market. So the question is this a valid pullback? Let's find out. Grab your Fibonacci tool and draw it from the recent low to the high where price started pulling back. Now that we've done this, we can see price pulled back to the 38.2% level and even dipped slightly into the 50% level. This confirms that yes, it is a valid pullback. When price retraces to at least the 38.2% level, we consider that a healthy pullback. Now, after spotting a valid pullback, there's one more step we'd always take. We mark the weak high and watch to see if price breaks above it. If price does break above that weak high, it signals continuation. And that's exactly what happened here. Price broke to the upside, giving us a break of structure. After this break of structure, we can confirm that the recent low is now a strong low, which is important for the trend. Let's keep going. Price moves down a little, so we check if this is another valid pullback. Again, draw your Fibonacci from the previous strong low to the new high. What do we see? Price didn't reach the 38.2% level, it stayed above it. This means it's not a valid pullback. We can label this area as noise or a minor continuation zone, but it's not a proper retracement. After this, price pushes higher again. Once more, we draw the Fibonacci from the new strong low to the high, and this time, price pulls back nicely to the 38.2% level. This is a valid pullback. We mark the recent week high, and later, price breaks above it again, giving us another break of structure and confirming the new strong low. Moving forward, we draw Fibonacci again from the new strong low to the high. Price pulls back again and touches the 38.2% level, so once more, this is a valid pullback. We mark the week high, but now something interesting happens. Instead of breaking higher, price reverses and moves down, breaking the strong low. This gives us a change of character. After a change of character, the trend might be shifting, so the previous week high becomes the new strong high. Let's keep tracking. Price pulls back slightly. We draw Fibonacci from the new strong high to the low of the pullback. This time, price doesn't touch the 38.2% level, so again, it's not a valid pullback, it's just noise or a minor continuation. After some time, price moves lower. We draw Fibonacci from the strong high to the new low. Price pulls back slightly upward, and this time, it touches the 38.2% level and even dips into the 50% zone. This is a valid pullback, so we mark the new week low. After that, price continues breaking lower, giving us a new break of structure and confirming the strong high. One last step, after the new break of structure, price pulls back again. Draw Fibonacci from the strong high to the new low. Price touches the 38.2% level once again, making this another valid pullback. We mark the week high, and later, price moves impulsively downward again, giving us another break of structure and confirming the new strong low. Let's talk about one of the simplest yet most powerful trading rules: buy low, sell high. It sounds basic, but when you connect it to how price truly moves, it turns into a game-changing strategy. Let's start with an uptrend. Picture this: price is forming higher highs and higher lows, a strong, healthy uptrend. After a big push upward, price usually pulls back. This is where we want to step in and look for buys, but not just anywhere. We want to buy when price is cheaper, when it's offering us a discount. Here's how we find it. Grab your Fibonacci tool and measure from the lowest point to the highest point of the move. Now, watch where price pulls back. If it retraces to around the 50% level or deeper, that's what we call the discount zone. This is where you're getting a better deal and giving yourself a much stronger risk-to-reward ratio on the trade. Alright, now let's flip it and talk about a downtrend. Picture price forming lower highs and lower lows, a steady move downward. After a big drop, price usually pulls back upward slightly. But this time, we're not looking to buy, we're looking to sell high. Same approach, grab your Fibonacci tool, but now measure from the highest point down to the lowest point. If price retraces to the 50% level or higher, that's your premium zone, the sweet spot for looking to sell at a better price. So, to keep it simple, in an uptrend, you want to buy in the discount zone. In a downtrend, you want to sell in the premium zone. Once you start trading this way, combining market structure with premium and discount levels, your setups will make far more sense, and you'll feel much more confident when taking trades. Alright, now, let's put everything together. This is where it all starts to make sense. Start by picking any high point. I'll start from here. You can see price begins moving down, and we expect the market to form lower highs and lower lows, signaling a bearish trend. After a while, price pulls back. Now, grab your Fibonacci tool and draw it from the high to the low. Price retraces to the 38.2% level and even taps the 50% level. That tells us it's a valid pullback. So, we go ahead and mark the week low. Since the market is still pushing down, we expect bearish continuation, and eventually, price breaks lower. That's our break of structure, confirming the downtrend. Next, we need to mark the strong high in this move. To do that, draw a horizontal zone from the week low up to the breakpoint, extend it upward, and find the highest point inside it. That's your strong high. Price then pulls back again. Let's check if it's valid. Use your Fibonacci tool from the strong high to the new low. Price comes back to the 38.2% level and even hits the 50%, so it's another valid pullback. We mark the new week low. But here's where something changes. Instead of continuing down, price breaks above the previous strong high. That's a change of character. Because of that break, the week low now becomes a strong low, and the trend flips from bearish to bullish. After the change of character, price pulls back again. Use your Fibonacci tool from the new strong low to the new high. Price retraces to the 38.2%, confirming another valid pullback. We mark the week high. Price pushes up, breaks that week high, and gives us a break of structure. As always, we mark the strong low, the lowest point before the break. Price pulls back again. Using the Fibonacci tool from the strong low to the high, this time price doesn't even touch the 38.2%. That means it's not a valid pullback, just a continuation move. Price keeps climbing, then pulls back again, and this time it does reach the 38.2% level, maybe a bit deeper. That's valid, so we mark the week high. Price pushes higher, breaks it, and we mark the next strong low. Once more, price pulls back, this time hitting both 38.2% and 50%, so we mark the week high. Now here's the twist. Price was moving up, but suddenly it breaks below the strong low. That's another change of character, flipping the market back to bearish. Because of that, the last week high now becomes the strong high. We mark it by drawing a horizontal zone from the strong low to the break, extending it upward, and picking the highest point inside. That's our strong high. Price drops sharply, then pulls back again. We draw Fibonacci from the strong high to the low, and price reaches the 38.2%, valid pullback, so we mark the week low. Price then breaks that week low, break of structure, and we mark the new strong high. After that, price pulls back slightly, but doesn't touch the 38.2% or 50%, so it's just a continuation move. Price keeps falling, then finally pulls back deeper. Using Fibonacci again from the same strong high, price hits both 38.2% and 50%, valid pullback, so we mark the week low. Why does this matter? In a downtrend, week lows are expected to break. In an uptrend, it's the week highs. Later, price breaks lower again, giving us another clean break of structure, so we mark the new strong high, which is the highest point before the break. And that's the process. Follow these steps consistently, and you'll stay in sync with the market. A lot of traders ask me, which time frame should I use? Here's the truth. It's not really about the time frame, it's about the structure. Whether you're on a 4-hour, daily, 15-minute, or even a 1-minute chart, the way you read market structure doesn't change. The key is staying consistent. I'll be covering this in more detail in an upcoming video, so make sure to like and subscribe so you don't miss it.